Welcome to Offshoot, the Fident Capital podcast with host Kevin Choquette. Offshoot is a curiosity-driven conversation that features a wide range of real estate and business professionals. In each episode, we unpack the knowledge, vantage point, and domain expertise of our guests. Then we move beyond the facts and figures and dive into the personal habits and mindset which allow them to be high performers in their respective field. This podcast's objective is simple: supporting entrepreneurs, fostering relationships, and uncovering meaningful conversations that positively impact business.
Welcome to episode 33 of Offshoot. My guest today is Mark Roppolo, Director of Investments at HFS Capital Partners, a Dallas-based alternative investment manager. As an LP investor looking to put $4 to $15 million into each deal, Mark's team of 3 investment professionals has completed over 70 real estate deals and deployed over $280 million of equity through a couple dozen operating partners. Mark's a Naval Academy grad who flew helicopters off destroyers before diving into commercial real estate, where he's worked his way through everything from multifamily development to pension fund advisory to trophy office asset repositionings. What's intriguing about Mark and his partners at HFS is their ability to be truly contrarian. They're not a fund, but they're not quite a family office either. There's something in between that lets them be incredibly patient and selective. That's a discipline and mindset that you don't see in institutional shops who eventually must deploy capital, as returning it to investors is not an option. HFS capitalizes each deal individually, partly through their affiliated wealth management shop, giving their investors discretion on each investment. There are no blind pools and no forced fund liquidations. Yet, they've never had a failed capitalization. As you'll hear, that track record comes from a ruthlessly selective DNA and relationship-driven approach to their investor community. They also invest alongside their investors on every deal. Listen in as we cover topics that include how they stole an 800,000 square foot office complex at a 20 cap, an asset which now is 94% leased, how they diligence boutique operators, and how their underwriting is always focused on the strength of the sponsor, why they avoid marketed deals entirely and instead focus upon sponsor-sourced opportunities, how they support operating partners when deals hit speed bumps, the discipline to do just 2 deals in a year when nothing else penciled, and why their investors appreciate the patience to invest only when they like it, the advantages of their hybrid model that acts like a family office but isn't dependent on any single investor, why real estate success isn't about being the smartest, it's about tenacity and getting more looks at deals, the power of Mark's Naval Academy peers and their accountability. If you can't explain a deal to a classmate, something's wrong. And finally, how staying connected to the pointy edge of the spear through daily conversation drives better investment decisions. Mark's journey from military service to institutional investing through to this brand of capital allocator provides a great perspective on what disciplined investors are seeking for top performance. I hope you enjoy it. Good morning, Mark. Welcome to the podcast.
Thanks. Good morning.
I appreciate you taking the time. I know you're a busy professional and time is short.
Well, happy to be with you.
So, if you would, just to get us rolling, you are with HFS Capital Partners out of Dallas. Tell us about the firm. Tell us about what you do there.
Sure. HFS Capital Partners is an alternative investment manager that looks for interesting, risk-adjusted, kind of story-driven opportunities in real estate, which is my primary focus. And then we also have a significant practice in investment portfolio in the oil and gas minerals space, which one of my partners runs, and we have a whole team that goes out and sources those opportunities. So between real estate and royalties focused on the oil and gas space, we offer some interesting private equity opportunities to investors within the firm.
Yeah, and One of the things I'm really intrigued by with HFS is you have a sister company, right? Which is HFS sort of wealth management. I don't know if that's the exact moniker, but it's a related entity, right?
That's right. The capital partners is a component of the wealth management firm. The wealth management firm should be thought of as kind of the parent, and they do all the traditional wealth management services uh, for a variety of high net wealth individuals. And we within the capital partners invest partners of the firm's money as the lead on any investment. We can go into it further, but we fully believe in aligning the interest as closely as possible. And these are attractive. If they're not attractive for us to individually invest in, then we shouldn't expect anybody else to invest in it alongside with us.
That's partners of the firm, as in principals of HFS Wealth Management or HFS Capital Partners, or maybe both.
But both.
Both. Okay. Money where your mouth is kind of an idea.
That's right.
Yeah. And then on the remainder capital, so say I bring you a deal and, hey, Mark, we're looking for $5 million LP equity to build a multifamily asset in Southern California. The balance that doesn't come from the partners, is it exclusively funded from the HFS wealth management side, or is that just a part of the sort of capital raise that you would do to fill out a subscription?
Yeah, I don't, my partners really lead that kind of allocation efforts, but I do not think of, we just think of investors um, for a private offering of folks that have routinely invested with us. They're all known relationships. We don't go out and use social media to try to find investors like a lot of syndicators do and have been successful with. So we have a significant um, investment from non-wealth management clients, but you have to have a relationship. We need to know who you are. We need to know that it's appropriate for you, and that we want to invest. We want you to invest with us.
Yeah, that's cool. We'll get into that, but that's really helpful. Where are you guys seeing opportunities, challenges? Like, what are you seeing in the market right now?
It's, gosh, you see a lot. It's a confusing time in many respects. So let me back up and say that for the most part, I find the space markets, if we would define kind of the relationship between the landlord and the tenant, and therefore just think of it, the rent rolls and the occupancy, I find those mostly to be pretty healthy. Of course, there was a lot of new deliveries on the multi side and on the industrial side, which the vacancies have caused some overhang, which is getting worked through in these lower barrier to entry markets. So in general, pretty healthy there. Of course, the significant increase in the interest rates, starting in the April of 22, has really disrupted kind of the capital market side. It seems like that's starting to get worked through, but there are a lot of loans that you and I both know that were initiated with floating rate debt with low cap rates that are not performing, and we see a number of deals that can't close just for the debt, the debt value. So I think that's still going to take a while to work through, and of course that's presenting opportunities which we're trying to stay in front of.
Are you guys seeing much? So let's just go to the executed a loan on floating rate terms. The index went up 550 basis points. And so what might have been, let's just say 4% money suddenly turned into 9% money. And so they've got negative carry on the debt and they're facing maturity. There's not enough cash flow from the asset to be able to service the debt. And it's either a cash in refinance or kind of extend and pretend, or there's actually an event of distress or default. Are you seeing much capitulation either on behalf of the lender who may be a little bit overextended on current asset values, or on behalf of the borrower who's like, hey, I'm not putting good money after bad. Our equity's impaired, if not wiped out, and let's just walk. I'm just curious.
Yeah, I don't. I have not seen many cases in which the lender is taking a write down. Discounted payoff. Although we did have a very significant one in the office space last fall, which presented a one of the more compelling opportunities we've seen on the multi-side, the multi-tenant side, industrial side. We have not seen any kind of significant discounted payoff opportunities.
Yeah. We talked about that office deal just because I think it's interesting. Refresh my memory, because I remember you telling me this story and I was like, okay, that's compelling. Like there's a lot of talk about vintage in real estate, and there are some vintages like wine are better than others. That the vintage that's printing now may prove to be a very good vintage because there is a little bit of a basis reset. Refresh my memory on that office deal you guys did.
Yeah, and I need to preface, just to make our compliance people happy, that nothing I say should be, implied as any kind of investment advice.
Perfect.
Yeah. So it was a 2-building office park in a suburb of Dallas that each building was about 400,000 feet. And the weighted occupancy between the 2 buildings was in the low 70% range. One of the buildings was completely occupied and had 4 years of term remaining, and the other building, say 40 or 50% occupied. It was kind of the fully occupied building. You're not really sure, a little bit functionally dated. You probably wouldn't build it like that today. It had a really large footprint. So we thought that it certainly could be compelling on just a land basis alone, which helped us get very comfortable for that building. The mid-rise office building, 16 stories, nicely refinished. Had the previous owner had totally redone all the common areas, the elevators. That building, we thought, this is a good A- building in an area that has a lot of the value office workers. And since we bought that building, that portfolio for truly a 20 cap on in-place income.
Wow.
And there was 4 years of term remaining. So I was seeing many deals I marketed with, 12 cap, but there'd be a year and a half or 2 years of term remaining, and that still wouldn't get you a very compelling position. So this was a very unique opportunity. Since we closed that, we signed a very large lease with a Fortune 20 company, and we're 94% leased
On the mid-rise?
overall.
Oh, wow.
Yeah. So our 20 cap will when they start paying for a period, we'll be in the 28 cap
Jesus.
on total adjusted cost.
So just there's 2 buildings. I just want to understand it. The one that you're saying dated footprint and good for land was what, a low rise, sort of large footprint building that was 100% occupied?
That's right.
Okay. And then the tower was only 40% occupied, but had gotten a lot of the value add treatment.
That's right. And that market has a lot of corporate users. I think what made it compelling, or what created the opportunity, is the lender had tried to market it unsuccessfully a couple times, and they had an agenda to move it off the books before into 2024. Our partner, we always invest with on the real estate side through operating partners. Our partner is very skilled, and is one that often gets calls for difficult things that others can't do. And this created quite an opportunity for both of us.
And so when you say on the low rise portion of it that you were comfortable with it just as land value, you could actually underwrite holding it for the 4 years, letting the remaining lessees burn off term and then just scraping it for either new office or alternative uses.
That's right. We do feel there are a number of interested users should for half the building that are poking around and touring it now. So it very much could stay a traditional office use. But we got comfortable with the underwriting that if we could exit it for land value, then that was our downside.
But at a 20 cap, if you just bought it with cash 4 years in, you're down to 20% of your balance.
Yeah, you could exit the entire. You could tear both buildings down and still have a very good return just off of land.
So how many toads did you have to kiss to find that prince?
Yeah, well, that's the deal. It's this is thankfully a strong relationship that we have with this sponsor, and we certainly knew the brokers involved in selling it. But this is a world that you try to stay disciplined and look at everything that crosses your plate. And I get a couple hundred emails a day. You just have to review them and see where the opportunities may lie. And it's not always a lot of fun, but when the right one does come along, it certainly makes all those kissing the frogs worth it.
Yeah. I mean, I get to invest on occasion. If you called me and said I've got a 20 cap, okay.
Yeah.
Let's go.
Yeah,
Let's go.
The math was pretty easy.
Yeah. And how long was that relationship in place prior to having it bear that kind of fruit? I'm just curious because it's usually the case.
Yeah,
There's something there.
Over 10 years.
Yeah. Going back to like seeing banks take any sort of material write downs, although on that one it sounds like they did. How about deals where you've seen sponsors execute, right? They have a value add plan. We're going to do these improvements, move revenue this much, boost NOI this much, and then we're going to sell at this terminal cap rate. Now they see that terminal cap rate is no longer in market and are either going to execute perfectly on the business plan and break even, or even execute on the business plan and lose a bit. Are you guys seeing any of that, or are you a part of any of it on some of your legacy deals?
Well, I think from what we're seeing is often they're not executing on the, I spoke earlier that in general, the space markets are pretty healthy, but in most of these cases, those were kind of repositioning plays and they're somewhat in distress because of the amount of product that was delivered on the valuation. So they may have been, the deal worked at 95% occupied economic, but it doesn't work really at 88%. With rents that didn't grow to meet those, that underwriting. So that's where you're seeing deals that, that are not trading even for debt value. And I think the lenders are just extending. They have a decent asset. They don't want to take a write down right now.
Mm-hmm.
So that's pretty common from what we see on the multi-side, which is such a large asset class in today's world.
Mm-hmm. How long do you think that persists? Do you think the lenders will ride with these assets long enough that the markets stabilize and we get a little bit of rent appreciation, and then they're able to refinance out, and what could have been a troubled loan or a credit impairment becomes like a whole loan? They sell it maybe they just get a refi. They don't even sell it at par. They just refi out, and everybody gets to keep playing.
Yeah, I think that's that's what their expectations are. I think one thing I've learned from the previous two downturns is that this stuff generally takes a little longer to work through the system than you want to think. And this one certainly, this capital markets adjustment is playing out, and similarly, where this is taking longer to flush that product through.
I think that's especially true when you've got so many non-regulated lenders that, aren't facing the browbeating of the FDIC and other regulatory bodies telling them, you need to write this down and you just sort of move on.
Yeah, that's right.
Yes.
A couple of these cases I'm thinking of were certainly debt fund.
Hmm. So, real estate is a big portion. Oil and gas, I know, is another portion of what you guys do. We'll probably leave that alone because it's kind of not, uh, germane to what you and I get to discuss on a regular basis and the space I'm in. But where are you guys currently investing? I mean, you mentioned this office deal, which sounds super compelling, but where else are you guys looking to deploy dollars?
Yeah, we had we initiated two multifamily developments that were kind of unique opportunities. One was in a market that we had been involved with and had previous success. Uh, Started in 2019, sold in 21. We had a site that was teed up to do another investment. We thought it was the best site remaining in the market. We created it, or our partners created it. The land partners were contributing it into the development partnership, and it was rezoned. And then, due to some protests within the community and appeals, it went all the way to the state Supreme Court before that rezoning was upheld. So that was a deal we had been involved with since 2021. We finally kicked that off in first quarter of 22 of 25.
Okay.
So, you know, we think that when we deliver in 2 years, that the market will have the existing product or the new product will absorb. Nobody else will be able to develop in the meantime, and we'll deliver into a healthy market with a great product. In a similar story, we did another one with in a little bit of a tertiary market to Dallas, but has very little new pipeline. We were able to underwrite based on a deal that delivered May of 24 and leased up in record fashion at rents above what we needed to underwrite to get a very compelling return on cost.
That
Um, that's being a little bit contrarian.
to be doing
Uh,
development right now? Yeah.
yeah, and you know where you got to look ahead, and you got to feel like that these markets are going to continue to absorb and get real comfortable on what the remaining, what the pipeline, existing pipeline and potential pipeline that you could compete with. In both cases, we did, exhaustive due diligence and got comfortable with that.
The first one you mentioned, Q1 2025, the second phase of a project you'd previously been invested in. How did you guys approach that in terms of either a cap on cost relative to what you think the terminal value cap rate is and that spread, or if you think about treasuries versus the untrended cap on cost of the asset? Like, what kind of a spread were you looking for to justify Q1 2025, let's put a shovel in the ground?
Yeah. So, you got to get comfortable on kind of all the different metrics, certainly what the untrended return on cost is, what the price per unit, uh, is projected to be, relative to existing comps in the market. Certainly, you know, we've got to have, a premium to treasuries or, you will get the rent growth, but over time. But why would you take that risk to do it if you could just get it in treasuries?
That's fair.
And so we see that. Of course, we've got that's what we do, and uh, and so in both the cases, these were well above treasuries, and they were compelling. Not, I would say they were compelling in today's market, and I would say they were compelling in kind of a normalized market as well,
Okay.
without projecting trended rents.
So does that, like, if I know that all of these things are multifaceted, I'm trying to pin you on one metric, which is in some ways unfair, but just for the benefit of clarity, 125 basis point spread to the sale cap rate, 150 basis point spread to the sale cap. Like, what kind of litmus test might, basis
Well,
matters, leverage matters, market
yeah,
matters, all that.
yeah, absolutely, yeah, absolutely. We find cap rates can be a little bit kind of muddied, given that you've got, is that on taxes, on your property taxes adjusted, which are which are very significant in most of the markets we play, or is that not tax adjusted? And so we certainly will focus there. But if you would say Dallas today is trading, a new product is trading at, say, a 475 cap, which we wouldn't do, and we find that, not appealing to us. Well, this is a market outside of Dallas, so it needs to have at least a 50 basis point premium. So you're at 5.25. Well, if we can deliver for, in this case, since we're in a tertiary market, at least 200 basis point spread to that, then we're pretty protected. In this case, we were well above that.
Wow. 7.25 cap on cost. Above. Yours are above 7.25.
Yeah, we were actually above 7.25. And that's, based on rents that you could point right to. We had a GMAX contract, of course, that we ended up having savings in from the buyout. But, we are in, a tertiary market. So there needs to be a premium to that.
Right, because you would perceive less liquidity on the tail end of the investment.
That's right.
Yeah, and perhaps
potentially.
Yeah, and perhaps a little bit more fragility in the economy and the demand drivers and stuff like that.
But one of the things that's helps us is that we invest, and each deal is capitalized individually, and so we can capitalize a deal and hold it to what presents the best opportunity for the investment. We're not driven by some kind of fund constraint, either to deploy money or to harvest money.
Why do you guys do that? Why? I mean, I probably could make a guess, but the fund business in a lot of ways seems quite attractive. You circle up $150 million or $500 million. You take a couple points on an annual basis for managing it. You liquidate the fund in 5 to 7 years, whatever you make over baseline return to the investors, you keep 20% of, and you do it again. Like, that's a huge.
I think no, certainly it is. And we do have a fund that we use for smaller investments, say 2 to 4 million, which we can speak to. But there are several reasons. One, we as individuals, and the partners in the firm, and then as importantly or more importantly, for our investors, we want them to have the discretion whether they want to do a deal or not. Many people don't want to be in a blind pool kind of situation. And I think that's playing out more and more as people have hangovers from deals they were in or funds they were in that were initiated at peak market, and they're having to work through it, and they're getting unexpected capital calls, and they're getting stretched for deals that are underwater. So I think that's first and foremost. On the small balance, we have a deal we started for small balance opportunities that we do some debt within that, and then we have closed, say, 3 small single tenant industrial buildings, and then 1 small multifamily deal. That those don't make sense from a cost basis, from a cost to the opportunity for compliance, getting K1s, getting audits, the closing cost involved to do those on a standalone basis.
Just all the friction of a standalone syndication, single purpose entity, et cetera, et cetera.
Yeah, and then we have a hard time, allocating that appropriately among our investors. A $4 million deal, we would have, we'd be way oversubscribed, and then how do we
tell people no?
Manage that?
Yeah. So one of the reasons I wanted to get you on the podcast is, they're kind of very distinct players in the capital markets side, especially on the equity side. And a lot of people have this love affair with the idea of a family office or a ultra high net individual who is behind the family office. The space that you play in, you just sort of mentioned going shovel in the ground. Q1 2025 is very much a contrarian play. You're in this kind of hybrid registered investment advisor at least that's part of the backing that allows HFS Capital Partners to access some equity. It sounds like you also have, long-term, whether they're institutional or high net strategic relationships, so you can subscribe these things quickly because you're giving people discretion. But how do you think about the nature of your firm vis-a-vis like Goldman Sachs or Cross Harbor? Name your institutional capital allocator who has largely been absent from the multifamily development space. You guys aren't a family office. You're not an institutional fund capital allocator. You're somewhere in the middle. How do you think about the opportunities and challenges that presents you relative to the competition?
Yeah. So previously in my career, I was within the institutional space with a pension fund advisor. And, as I got a little longer in the tooth, I no longer wanted to be kind of in that world, which is a great world, but I wanted to be have a little more discretion and a little more nimble and, not want to be, mandated by consultants and, kind of fun timing that kind of pushes you to do one thing or another. Um, so we are, very unlike any of the ones you mentioned. Um, we only invest when we, find a very compelling opportunity that we have no mandates that says we need to invest X million per year or X billion per year. And so in, you know, 23 and 24, there's about a 24-month period where we probably did, you know, two small deals. And so that gave us we had a pretty, some dry powder and, our investors, you know, were appreciative that we were disciplined and staying on the sidelines. And so it gives you the opportunities to be a little bit contrarian. Now we're not going to be the biggest by any means. I would say that we look to our partners, to our operating partners. We look and act as far as they're concerned, very similar to a family office.
Mm-hmm.
We come in as one partnership. There's an ease there. We've never had a failed capitalization in 70 something deals. So it's pretty efficient for them. And then, we're not relying on any single investor.
You've got a big enough pool that when you guys go out, it's not a challenge to get it subscribed.
I wouldn't say it might not, it might require a little bit more work on our part, but we certainly aren't going to go into something that we don't feel like is well within our capacity to capitalize.
Mm-hmm. And right when we started, you said something about ascertaining the suitability of your investor for the deal. So, I'll be the wrong investor, right? I'm worth let's just say $1.1 million, and I want to put $300,000 in your deal, and I want to be out in 24 months.
Yeah.
How do you guys go about just making sure that you've got people who understand your ethos, the sort of risks that are incumbent with the deal, and aren't going to become a plaintiff or a fly in the ointment as the inevitable unfolds, whether it's, downside variance or a surprise to the upside or a little bit more duration or, there are things in real estate that happen. How do you make sure you've got the right people?
Yeah. So one, they have to be an accredited investor.
Yeah.
And, these are relationships. And there is a trust that's earned over time. That, and there's conversations. And so I would say that I'm not as involved on that side of it. But I think it's more common that we might peel or decrease an investor's appetite than try to push them to do more. That's not our role, is to try to, push somebody into an investment. Our role is to offer a compelling opportunity, explain to them why we think it's compelling, and then let them make the decision. If they're a client of the firm, the wealth management firm, then they certainly have a dedicated financial advisor that looks after their total portfolio and can look at everything holistically.
Larry Fink, I think at some point in 2025, came out and, he tends to be kind of one of these bellwether things where when guys like that make these kind of pronouncements, it tends to move things. But I guess the traditional wealth management model would be 60-40 stocks and bonds. And Larry came out saying, it's not 60-40 anymore. It's 50-30-20 stocks, bonds, and alternative investments, of which a portion of that would go to real estate. And I think Trump just came out with this executive order saying that 401ks ought to be able to get access to alternatives. Are you guys seeing that trend impacting your business at all? Is it a part of what you're up to, or is it business as usual and that stuff is sort of on the periphery? I'm curious about how you guys think about that.
I think it's on the periphery for now.
Okay. Yeah, it seems to me there's still a bunch of capital that wants to get into real estate with the statements like that, and the oil and natural gas business that you guys are in, and other private equity plays. I think there's going to be a lot of allocation from that individual investor. I think there's like $19 trillion in that bucket getting siphoned off and pushed into alternatives. But I don't know. Have you been tracking that at all?
I have, and when you look at some of these gigantic, funds, you understand why they would like to open up that vehicle, and knowing from high net wealth investors why they'd want to have those opportunities. So I think that there's an interest or some forces pushing from both the investor side and from the individual investor, and certainly from the fund manager side, the sponsor side on this making these changes. If anything, it's certainly just going to increase the multiples and drive down yields on places in which they'll invest.
Yeah, it could be good for anybody who's already in, right?
Yeah.
I just want to switch a little bit. My view of HFS as a capital allocator, the longstanding relationships notwithstanding, is that you might invest in, well, certainly within the fund that you just referenced, where you might put out $2 to $4 million, you're likely to be with a more boutique operation. But even in some of the other deals you're doing, they're not $50 or $100 million equity checks. And so you're probably by definition playing, again, with kind of a boutique operator. I'm curious how you guys run diligence and think about making sure you've got the right operating partner, especially on a new relationship, when that partner might have 3 to 5 employees or total headcount. I think that's got the opportunity to provide really exceptional returns because they are small and focused and nimble, but also could be hard to figure out, are these guys bona fide?
That's right. Yeah. So, on our normal deal side, which is those we look for investments are kind of 4 to 15 million. There's no hard or fast about that. It can be, we have done a little bit larger. We have brought sidecar investors alongside us if a deal, we like a deal a lot and it exceeds our capacity. But that's the normal bucket in which we play. And so, yes, we do have some smaller boutique, sponsors, and those relationships you form, you certainly due diligence them with background checks. You want to know that they have a history or performing within that asset type, within the business plan that they're proposing, and with some experience and relationships in the market in which they want to play in. And if you can diligence that by their history, and then, we certainly would never invest with anybody who has any kind of blights within how they treat their investors or any kind of, you know, legal financial misrepresentations. Life's too short to get into a deal with anybody with that kind of record.
The track record I get, relationships, what are you looking for in that side? Just that they have kind of the appropriate professional network around them?
That's right.
Yeah.
And, you know, if certainly the case that you use, they're going to use third-party management. We, I've had an operating background previously. You certainly can due diligence not only the firm, which those are, there's certainly the major players, the property management and leasing side, uh, but also the individual team, which we all know it comes down to the individual people. They're going to be working on your project.
Um, I'm curious in the space that you guys are in. It sounds, I mean, it's awesome. You get to sort of go, yeah, and we just bought a 20 cap. I'm sure that doesn't happen every year.
I think that's the singular one in all of our deal
It's
history. So we can be upfront about
the
that.
one and only.
Yeah.
But what do you think it takes to be amongst the best? I mean, I think you're spelling some of it out already in terms of being patient, being opportunistic, being okay with perhaps doing two deals when it's not the right time. But what else do you think makes it so you guys can provide, what you talked about at the beginning, appropriate risk adjusted or attractive risk adjusted returns?
Yeah, I think we try to be a very good capital partner to our partners. Um, if there's something that needs uh, our help, we're ready to roll up the sleeves and work through any issues. We have the ability to stay, after a property and you um, help from a strategic standpoint, from a structuring standpoint, and from a financial standpoint. So we're going to do what's right for the investment if it needs more help. Uh, we're, you know, there are some deals where we may only get, monthly financials and a quarterly report, and we may talk on a quarterly basis and just to say hi, and everything's operating, you know, as expected, and there's not much to do. And there's other deals which we need to talk, almost on a daily basis, and we're available to do, and we'll certainly do whatever is needed to maximize, our investment and our opportunity for our partners.
Hmm.
I think, you've got to understand what the operating partner wants, and you know, from you know their risk standpoint, from their profit standpoint, from their whole uh, agenda, and have a strong uh, alignment from the start, just on what the story is, what the expectations are, and then certainly on how you structure towards that. And then you just have to be flexible along the way, as no very few deals happen exactly as performed.
Um, you had mentioned previously that you guys can be flexible on duration. If it's the case that the value creation portion of a business plan could be just on the front end. Let's go back to your, two parcel office complex, the low rise and the mid rise, where now you're 90+% leased. Once you burn through probably free rent and TIs and, get the lease roll on the lower level building and that thing's stabilized, you could argue that the value creation's done, but your operating partner might have an attitude that double digit tax advantaged yield is something to be held for duration, as opposed to ringing the cash register, making a grip load of gain, paying taxes, and then having to go find another deal. Are you guys ever able to accommodate a longer term hold with your sponsors?
Yeah, we have some that it's certainly, if you go into one knowing that's the likelihood,
Hmm.
you can capitalize it towards that, and we can communicate with our investors, and we have all to have that expectation. So we have one like that right now. It's a retail power center we bought for, at the end of maybe 2016 or 17. It was a REIT that had an agenda to get out of middle markets and go towards gateway markets. So they were selling deals in the nines and buying deals in the sevens. And we put long-term debt on that. We recently refied out of that debt, and now we're selling off a parcel and distributing, additional monies towards that. So that's the best case on a kind of a hold period where it's a longer hold period. But if we certainly, you know, we would rather take our profits early and maybe leave a little bit on the table. Um, you know, pigs get fat, hogs get slaughtered. But we are um, we communicate with our investors, with our partners, and try to find what's optimal for both parties.
Mm-hmm.
Of course, you have in the end, if there's a disagreement, then there's a buy sell provision, and you just kind of work through that. I don't think that we've ever pulled out docs and gone into any kind of formal discussion on anything that's really in the partnership documents.
Mm-hmm. When you go on those rare occasions for a bit more duration, do you have a mechanism to reform the structure of, say, accumulating preferred returns and the waterfall and things like that, so that the GP, operating partner, is able to participate in cash flows and not forever be subordinate to an accruing pref? Or how have you managed where, past that first 3 years of value creation, they can begin to be more, I don't know, of an equal owner as opposed to,
Yeah.
yeah.
So we certainly have, we have not done many deals that are long-term holds, from the outset.
Mm-hmm.
So, but every deal, we're flexible on the structure and how those things work. We certainly get it from their standpoint that they, so in this case, you know, you're kind of presenting it in which they're wanting to stay in the investment longer term. So, you know, they have more upside. I don't, we're not going to cut a deal after the fact, to stay in it longer term.
Right. It should be upfront, clear. This is the strategy. This is the timeline, and if we're going to accommodate that, we'll do it now. But not once the sort of paint is dried.
Yeah, we've already communicated to our investors what the structure and the plan is. So that would be a little bit of field.
Yeah. Cool. That's all great color. One last question on sort of the nuts and bolts of your business. How much of the analysis that goes into the attractiveness of an investment is done pre-tax or post-tax? Is the tax in the post-tax returns of the investors part of it, or is there too much complexity in all of the different sort of, every taxed individual has a different fact pattern and their tax consequences are different. So do you just leave that out, or do you try to incorporate it into the analysis?
Well, so the firm had its genesis from a tax accounting business. So I would say they're extremely tax savvy.
Okay.
But we do not want the tax implications to drive any kind of real estate related decisions, or to justify the worthiness of an investment. The deal needs to work outside of kind of any tax treatment. But we do, optimize any kind of the tax implications.
Cool. Got it. So let's switch a little bit. That's all great. And I hope people can hear, I love your space, right? In my world, looking for equity capital, if I'm talking to a fund out of New York or something like that, I can call one and get the answer. And if I call 50 others, it's almost certainly the same answer. Like there's a little bit of dispersion around the mean, but generally that herd all moves together. The family offices can be truly contrarian because they can invest for a different duration. And I think of you guys as kind of a hybrid, right? Where you're independently minded, you make investment decisions on a case-by-case basis. based on the merits of the deal and also the macro. And I think that's just hugely valuable because there's more independence, right? There's more autonomy. There's more discretion. You just articulated, moving in a contrarian way to the market. And, to me, you guys are, I also think you're the future, this sort of RIA, tapping into the demand for alts and sort of allocating into this space. But I love the space you guys occupy. I think it's really intelligent.
Oh, thank you. I appreciate it, and you certainly enjoy it as well.
So let's switch to the personal side. Like, how did you? I know a little bit of your background. We've talked about, some of your academic and post-academic pursuits, but what brought you here? How did you get into, from college, which I think is a story on its own? How'd you get here? Like, what's that journey?
Yeah, no two people or journeys are the same. So I grew up in Dallas. Um, Went away to school thinking Dallas was the only place in the world. Uh, was fortunate to go to the Naval Academy uh, right in the post Top Gun era, and formed some great lifelong bonds, and was a formative experience. I studied economics there, and then flew helicopters off of cruisers and destroyers uh, in the kind of the in between the two Gulf wars. Um, Met a wonderful woman in San Diego, got married, now have 4 kids, which we just shipped our last off to college. So it's a new phase for us. But I went to business school at the University of Texas, hook 'em horns, as I was getting out, and had a Navy colleague who was at McKinsey. And so I thought, that's the world I want to go to. That's kind of what little I knew. Uh, and then the world had other designs for me as kind of that post.com 9/11 blow up. Uh, I kind of reevaluated what was important to me and what I thought I could be good at. And, I had no real specific skills besides flying helicopters and managing, leading, teams. Um, but I was pretty cross functional. I knew a little bit of engineering, I knew a little bit of equipment, I knew a little bit of finance from business school. I certainly had some economics background, uh, and I thought real estate would be a space in which I could find my way around. And certainly in Dallas, uh, there's just a incredibly rich history and tradition and talent pool coming out of the Trammell Crow, you know, um, the empire. And so I just kind of found my way into it.
Did somebody, I mean, you mentioned like the McKinsey relationship and that having some influence, which, you didn't go in that direction, but was there somebody that sparks your curiosity on the commercial real estate side, or was it sort of independent?
Uh, there was a couple classmates that had preceded me that were in real estate, and they kind of teed it up and said, "Hey, you ought to think about it." Um, and then, certainly I had always admired Roger Staubach. It was part of an inspiration going to the Naval Academy. And so he certainly had a great run in real estate. And um, so I would say that, I guess a little bit of the Navy connection, although there's not that many Naval Academy grads in real estate, but some of them were influences.
And so you come out, you were, what was it, 9 years in the Navy?
Yeah, that's right. I was active duty for 9 years.
Okay. Um, what's the trajectory? For like, you don't have to go through all the deals, but I know you've had a lot of different roles in a bunch of different commercial real estate firms to end up here. I think how long have you been with HFS now?
Almost 9 years.
Okay. Yeah. So what's the abridged version of, all right, I went
Yeah.
to Annapolis, I was a helicopter pilot, and then ding, ding, ding.
Yeah. Sure. I did this. I started in a stint in the multifamily world, and we had a development arm, and then an acquisitions arm, and a student housing arm, and then we had a construction. So that was pretty informative. It was a tough time. I remember we had assets in Atlanta where we were giving 3 free months on a 13-month lease.
Oh, wow.
You can do the math, and I didn't need to do much math before I figured out this thing's losing money. Uh, and so I did that for my intro, and then I went with a pension fund advisor where I learned kind of the institutional world in the office and retail space, the acquisitions, asset management. Kind of went through the GFC there. Um, Got to work with some great people and on some interesting assets and some good investors. From there, I followed what had been the head investor of that firm to an office value add uh, fund manager, and I learned that 1980s value add office in suburbs was a really hard way to make money when you had negative, leases, um, uh, as you're buying tenants. So that was a pretty educational formation, but I got to work on some great assets, and that gave me the experience to go run a trophy asset in downtown Dallas that was getting repositioned, and that was for a very large institutional investor, um, and some other large portfolios for an operating partner who was a very talented guy, and um, I learned a ton from him. We sold out the large chunk of the portfolio, the trophy office, an area called the Design District of Dallas, which was 800,000 feet of a repositioned real estate on that Trammell Crow started back in the 50s and 60s. We sold that, and we sold a couple other assets, and I wanted to transition. I thought somebody had said, "Hey, you've got a background that could be interesting to a group that acts and looks like a family office because you have the operating experience, you have the underwriting and acquisition experience, and you've kind of touched every asset class." And somebody made me the introduction to HFS, and that's how we got together.
Cool. The pension.
They had good success without me, um, and so I was able to kind of just join them and add to what they were doing.
Um, the pension fund advisory space. Who are you between? The pension fund is the client, and you're talking to the fund sponsors.
So we had the direct relationship with the pension funds. We had CalSTRS, Ohio Public, Oregon, Stanford, University of California Regents.
You're advising them on then portfolio composition and allocation into different operators or different funds, or what did that?
No, we were buying assets directly for them.
Oh, wow. Okay. Just going direct onto their balance sheet.
Yeah, we had separate accounts.
Okay. That's an interesting role.
Yeah, we did have some fund, but the majority of that was done through separate accounts.
Wow. And so those were
there could have been a Townsend or a Cambridge or another consultancy that was involved, but we reported directly in most cases to the pension fund.
That was like core assets or core plus assets that are just sort of bolting down the almost annuity portion of their portfolios.
Yeah, there was a mix between kind of the risk spectrum, but there certainly was a core component, and we did have some value add. We did have some development allocations depending on the client.
What was your role there? Were you acquisitions, or were you what did you do there?
I did both acquisitions and asset management.
Okay.
Certainly, when the GFC came along, every acquisition person became an asset management person.
Right. That's right. Well, you bought this stuff. Go figure out how to fix it.
Yeah. Yeah.
And then the value add office fund, you said something about negative leases, which I hear that as by the time you got done paying TIs and leasing commissions, you'd given away so much of the pro forma revenue that you're not really making any money.
Yeah, that's right.
Yeah.
This is to get it from say 70% to 80%, or you, the hope was that you made your money going from 85 to 95%, but that's very seldom the case, especially in the markets in which we played, which were Dallas, Houston, uh, Atlanta, and some of the other southern markets.
Hmm. I should have brought it up. It's that we don't have to follow any particular order, but in my mind, there's dissonance here. It doesn't matter. The team at HFS, what does that look like? How many people are on your side? Which is to say, we underwrite, we structure, we offer on uh, LP equity investments, and then we deploy capital, manage the partnership, manage the asset, hold it through for a redemption, and recycle the funds. How many people are on that side of the
Yeah,
business?
I mean we're extremely lean in that most of the work is done by our operating partners. Um, so there's myself who's often finding the opportunities and presenting them, underwriting them. Stephen Howard, who oversees all of our private equity and investment opportunities, and then we have an analyst. And then Stephen's brother John oversees the entire firm, so he certainly weighs in on kind of any allocation approval, any capital events. Um, so it's really three that have kind of a voice in a real estate opportunity. We're not real formal in that we have an investment committee that meets every Monday morning, and you have to put your package together by Thursday night, uh, and then present. It's we get together on an as needed basis, which is sometimes multiple times a day, and sometimes it's every 3 or 4 days.
And you guys have done like 70 deals with that?
I have. I don't have the. Yeah, it's over 70.
I love it. That's awesome. Um,
Yeah, I should know that.
uh, a lot. The leverage of deploying capital into real estate. I mean, that's exactly how I think that's how it should be. If you were to compare that, I bet, to the pension fund advisory and the headcount that was required to move those dollars, I think you probably have a better model.
Yeah, but I would say we don't have the friction, which is necessary when you're moving that much money in the large institutions, but we do have the same level of due diligence, and you know certainly all of our major assumptions are scrutinized. I personally, when I'm underwriting a deal, will call all the competition and shop them. Uh, you know, w- that discipline that came from being in the institutional world, we follow it, just in a little less, formal manner and that you would expect from those larger institutions.
Hmm. When you look back through, the pension fund side, or that value add office fund, or working on the um, portfolio with the operating partner, um, and I guess there was that trophy asset as well. Anybody stand out, or even perhaps in your Navy days, or even your schooling, influential mentors who have kind of helped shape your thinking around not necessarily just business, but kind of how you're approaching what you do?
Yeah, I'd say there's a number of them. Certainly, I'm proud of my Navy classmates, and while that's not necessarily a direct relationship in real estate, there's often a, a support and an accountability that you have from those relationships. Um, and if I can't explain it to one of them, um, then something's wrong.
That's
Uh,
cool.
so I have a good deal of that. I think I have relationships across all the different functions of the real estate world, attorneys to construction to architects to engineers, leasing. And so, you kind of tap into those, as you need. Um, you know, coming from the operating side, everything really starts with the land, and then it starts with and then it's leasing. And that is a world into both of those are world into themselves, and you've got to be well connected there to be able to understand um, the opportunity.
I really,
But Dallas has such a rich real estate community. We have a big organization here called the Real Estate Council, which I'm a member of and have been involved in. And it's extremely collegial. You can reach out and introduce yourself with it for any kind of needs you have.
SMU is a huge part of that too, isn't it?
SMU is an impressive school. It keeps on growing, and they do have a great real estate school. I know the director of it, and the guys that kind of backed it. And they just got a new president from the University of Texas, which is I think going to carry them on to another to another level.
Yeah, I've only heard good things about it, but I want to go back to what you're saying about your Annapolis peers. It sounds to me like I'll try to keep us off the explicit tag on the podcast, but it's the no BS kind of check, right? If you can't call up one of your peers and say, "Here's the opportunity. This is what I'm doing. What do you think?" and have them go like, "Yeah, that makes perfect sense. You should do that." It's just like you've got a quick reality check with those guys because there's enough camaraderie there that they'll call a spade a spade.
That's right.
Yeah.
There's a candor.
Yeah.
And and that expectation of transparency and accountability.
Mm-hmm. So you fly a flag that says I've got capital, which has for sure people like me who are in the business of seeking people like you out, calling and emailing. You mentioned earlier that you might get 100 emails a day, and that this most recent deal, is the one and only 20 cap. How do you manage, like in a capitalist society, people who have a sign that says I have capital tend to be in high demand. How do you manage the noise that might come along with that and try to find the needles in the haystack, not be dismissive of people, but also just be respectful of the finite resource that is your time? How do you deal with all that?
I don't know that I still have a ways to go there. If part of, or I am in way too many marketing selections by the different capital markets brokerage teams to where I'll get stuff that is not germane. And I signed up for them wanting to be able to see all the volume. We're certainly very sponsor driven, so that helps us become efficient. But there are a number of things that I try to stay directly in touch with and look at, and then maybe steer it towards a partner if I find an interesting opportunity. I'd say that's pretty rare, but I think it has happened. I did find a deal last year that was easily something I could have dismissed. It was just an email that had a pretty good subject line, and I kind of dug into it, and it was a lightly marketed deal that a sponsor had tied up off market, truly off market. And it was one of the better risk adjusted, pricing. The seller had some personal issues, was very high net worth, and had paid down his loan. And we were able to buy it for well below what he had bought it for in a great submarket, multifamily asset. So, finding that needle in that haystack, and I wouldn't say it was just by looking at the emails and following up, kind of reminds you that you need to stay diligent. And I hope I treat all those that call me well, and some of them want more candor than others. Some of them like the candor, some of them don't. But I try to give feedback if they really want it on how I look at a deal and why it's not appropriate for us. We're seeing a lot of deals getting recycled.
Mm-hmm.
3 or 4 times, moved on to a different brokerage firm. It was there on the market last year. It's on again. So, that kind of points in the direction of what's, where the sentiment is. Do you want to kind of pick up the falling knife? There's no perfect answer to that. And it's just trying to stay attuned to what's going on.
Do you have the sensation that there's uh, too many checks if you're if you're the short order cook in the back of the kitchen, or are there too many checks to be able to sort of handle all of that inflow, or have you found a calm and ability to kind of address like I said, my perspective is if you're flying a flag that I've got capital to allocate, you might be a bit overwhelmed with what we might call inbound leads.
Yeah. I mean, we really do not, not trying to, you know, be tried or whatever, but we really do not try to do market deals.
Uh-huh.
So, there needs to be, we want to make our money on the buy. That's the easiest place to do it in real estate. And we know a lot of things can happen, but if you have the right basis, the right team up front, then you've avoided a lot of downside, which is kind of the job number one. And so it's the like the broadly marketed deals we do look at, but one of the reasons why I got out of that pension fund world is everything was done in an auction environment there,
Yeah.
and I it was just certainly when you're asked to do a fourth round of best and final,
Right.
well, that's not compelling. And I no longer wanted to be in a world where, it's either the lowest cost of capital or the one that pushed their assumptions, their underwriting to, further and further from the edge. I didn't want that to drive the investment decisions I was involved with, because I had a long experience operating it, and then somebody's got to go manage it, which often was me, and explain why it wasn't hitting pro forma, 3 years later.
Hmm. Yeah, that fourth best and final is compelling only for the seller.
Yeah, right.
Yeah. What about like your more, sort of personal side on a day-to-day basis? What do you do to sharpen the saw, keep you at your best? Sort of. You talked about readiness in a military sense previously, but how do you stay sharp? How do you stay ready for the day?
Yeah. So I, get up, check the news. Got a dog. I walk. I listen to a ton of different podcasts and books and audio. That you know a lot of business oriented ones, but then some stuff out of left field and some technology related ones and history. And then you get to the office and I've already checked emails once at home or twice, and then you get in the office and you just kind of plow in. It just depends on the day. No 2 days are the same, but you know, try to if you're not talking on the phone multiple times a day to somebody that's involved and close to the pointy edge of the spear, then you're not staying as sharp as you need to be. And so, doing that, breakfasts, coffees, lunches, um, those just keep you top of mind and keep you informed on the relationships within the softer side of how the deals work and how the relationships work. And that allows you to often vet a potential partner or call on, um, you know, those allow you to explore kind of the softer sides of the relationships, which I think make real estate unique.
Uh, I had a gentleman on the podcast a while back, Jack Cohen, and he built a pretty significant mortgage brokerage, mortgage banking business, and had this comment that real estate isn't, and in particular, my business isn't a business that you outthink. You simply execute it, right? You get up, you get in the field, and you play the game. And I very much heard you say that, right? Where if you're not talking to the people with boots on the ground who are seeing the market, making the moves to create value, then you're losing touch with what the actual business is.
Yeah, I get calls, emails of how do I get into real estate from different, you know, young people coming out of college or coming out of the military or wherever. And I often try to say, it's not that complicated of a business,
Hmm.
but it does require, I think, the more looks you've had, the, no two deals are the same, but there is some rhyme there. And I'm a whole lot smarter than I was 10, 15 years ago. Or I would say I'm a whole lot wiser than I was 10 or 15 years ago. And I think I have more patience than I did then to be able to see through kind of the different facets of a deal and the different facets of a relationship. Um, so while it's not that complicated, experience does matter, and relationships matter. So just try to build on those.
Um, it might be the same answer to like your daily routine and sort of being at the front of the spear, but um, how do you continue to grow? Like, how do you just said you maybe are materially better now than you were 10 or 15 years ago? What are there any other practices that you have that you pursue to cultivate that improvement, or is it the tenure in the business and sort of being in the game, the experience?
Yeah, we're pretty. We don't want to get real inventive. We're not trying to go out and create some kind of new asset class,
Hmm.
but you do. Um, I do try to expand the horizon and look at things that I don't have as much experience in. They're a little bit more bespoke, and then get educated there. And that one, I can sharpen the saw. Two, it can form some new relationship. Three, help you look at something that maybe is closer to your field in a new light. So there's always something new coming along that I'll dive into, or a new submarket or a new market. I love learning about uh, a city or a submarket within a city and what's driving that. And so I'll spend you the besides this stuff that we mentioned earlier, the market and the demographics and the are just fundamental. And so a lot of time on learning about a submarket.
On the idea of topics that might be a little bit farther afield, do you have any recently that you've pursued to kind of go down that, like, hey, I'm going to go look at something that's a little atypical to, well, let's just say, value add multifamily investing um, lately? Like, is there anything you've been tinkering with lately?
Well, um, we invested in one of the developments that I mentioned earlier. It was in Waco, Texas, and Waco's 100 miles south of Dallas on I-35, midway in between Dallas and Austin. And Austin has pretty much grown to Temple, and then another 30 or so miles from Temple to Austin. There's certainly green space along there. Dallas has grown down to, say, Waxahachie, uh, and then there's a little bit of green space, but it's filling in a significant way. And within the Texas Triangle, which is I-35 down to San Antonio and then over to Houston and then up to Dallas, is just an overwhelming amount of population and job growth and GDP, and the gross product associated with it on the economic side. And um, so already well familiar with the economic drivers there, but having to dig deep into Waco to get comfortable that we wanted to have a new development there was something that required quite a bit of study and conversations. And so, did that. And there were job, announcements and new capital investments from the manufacturing side and the being done there that, we're not, well, while we're maybe known in certain sectors of Waco, we're not front page of Dallas, Dallas Morning News or such. So that's an example of one that did come to fruition.
Do you guys end up investing?
Yeah, we did.
Oh,
That's
cool.
one of um, our multifamily developments.
Oh, cool. Um, shifting a little bit, how do you think about, I mean, it sounds like you're getting some calls from younger folks trying to find their way, which I would say taking those calls in and of itself is a bit of a give back. But what do you think about, this idea that we're all walking on trails that somebody built before us? What's your view of potentially giving back as the years unfold?
Yeah, absolutely. I certainly was helped along the way, and it's something I'm trying to do. My wife and I have 4 kids in college,
That
so
sounds cheap.
we yeah, it does. So, uh, um, I help a number of their classmates and peers around them, years around them that we know, and um, as well as people that just reach out to me out of the blue. Um, and I'm paying it back and I'm paying it forward, and hopefully somebody will do that for our kids as well.
um,
But it's rewarding, and it also it keeps me sharp and in tune with that generation, and it helps me understand where my kids could be in a couple years. Uh, and they while they maybe are unwise to our industry, they have a new insight and into tech and to things that are as an old stodgy guy, I'm not quite as informed about.
yeah. What's their pulse on AI?
Wow. You know, I mean, I don't know that I have, certainly in the academic world, that's a fascinating how that's changing the instruction and what's cheating and what's not and
Hmm.
what's plagiarism. And but the power it can do is amazing. Our analyst, uh, he was able to do some stuff through AI, that I didn't know you could do. I
Hmm.
certainly love using it for queries and for finding information, but for modifying PDFs and Excel models and et cetera, it's just an incredible force multiplier um, that I think is extremely early in its adaption.
I remember when you and I are roughly similar age, when Google Earth showed up, right? And
Oh yeah,
you're like, wait, I don't have to like pull up a Thomas guide and go figure out what sector this is and like drive to the corner to see the real estate. I can just type in the address. I mean, there's nothing like boots on the ground. You can't replace it with Google Earth. But that was like, it sounds silly, especially in the face of something as powerful as AI, to recognize that Google Earth was kind of revolutionary to the industry. It feels like that, right? AI is just at that same sort of vintage where it's like, oh, there's Google Earth. This is interesting. But we haven't even figured out how to use it. Not really. I mean, we're finding new stuff weekly, and it's just incredibly powerful.
it is my probably number one website.
Yeah, GPT or Claude. What do you use?
No, Google Earth.
Google Earth. Oh, yeah. No, of
Yeah,
course, totally.
yeah, I'm on it all the
Yeah,
time.
yeah, that's funny. Um, Entrepreneurs, developers, even guys that are in a shop who have that sort of entrepreneurial grit, they may be employees, but they have the plot. They're willing to take ownership of and some responsibility for the outcome. What message do you have for guys who maybe just have done a couple great deals? Maybe the guys who are given the keys back or having worked on deals for 4 years and
You
breaking
there?
even. Um, in terms of, the journey and what you've learned, something you might want to share with them.
You, you broke up a little bit, but I think I got the gist of it. You know, it's the hardest. It's the hardest thing I think that there is, and to be full candor, I've not. I've always been. Uh, I'm not created. A platform on my own. My partners and they did it, and so I have to give them credit. But if it seemed easy, or if it was supposed to be easy, then nobody would do it, or everybody would do it. And so it's not supposed to be easy. But if it was easy, then there wouldn't be, there wouldn't be the rewards that you can have monetarily or just the satisfaction of rolling up your sleeves and getting dirty and figuring it out.
Yeah. And any advice to those guys? Like, hey, this is I mean, you've undoubtedly you have had people come to you who I'll be judicious and say, you would just be like, yeah, well, thank you. You're this isn't a fit for us. You might say different things over a couple beers. Um,
Yeah.
and of course, you've probably also seen sort of best of class, but any, um, like think of this as the peer of your uh, college age children when they are asking like what are the nudges that can get people a little bit more on signal um, to just sort of stay the course or not lose faith or I don't know
Yeah.
any thoughts on that.
Yeah. I mean, you just have to be tenacious
Yeah,
and stay at it. But, a lot of success in life is luck and timing. And so, you can only control what you can. And if you can fight through what seems like a tough time to do something, then you're going to be rewarded for it as there's going to be less competition as develop. So,
the war of attrition.
yeah,
Yeah.
no, it's, I admire guys like you and that have started up a platform and have created opportunities for yourself and for people that you've employed. And that's what makes us all tick.
uh, I was at a conference of entrepreneurs years and years ago and the question came up, um, if you had known now or sorry, known then what you know now about um, the requirements that would be put on you to start the journey, the entrepreneurial journey, um, would you have done it? And
Yeah.
almost universally, everybody says, hell no. Like you don't, you actually don't. It's very hard to understand what you're getting yourself into when you jump out of the airplane. It's not unlike having children. You're like, yeah, let's have kids.
Yeah.
And
Right.
you're
Right.
like, oh my God, look at this. That said, I think, if you ask the second question is, okay, but would you take it back? Did you make a mistake? Do you regret it? They all say, no, of course not. Like it's been a wonderful journey. So it's a funny thing about that. It's exactly like having kids, I think. Um,
Yeah. Yeah. That's a great antidote.
yeah. Well, look, Mark, I appreciate you taking the time. I'm going to give you the mic for closing comments, thoughts, anything you want to share. The listeners who've come this far, I'm always told to remind you, follow or like or subscribe or drop a review for us. It makes a difference to the algorithms that seem to control modern day life. Mark, the mic is yours, and thank you very much. I really appreciate the time and all of your insights.
Well, as always, Kevin, I enjoy talking to you. I find you with have great insight and curiosity, which I think is so important just to discovery and to growth. And so I've enjoyed our conversation as always.
Great. Thanks, Mark. I appreciate it.
You bet.